On the podcast with us today is Caleb Bryant. Caleb, welcome to the podcast.
Hey, Dan, how's it going?
Doing awesome, doing great, doing well. Looking forward to this episode. I know you have a project that you're in the process right now of closing, which we're going to have you jump on. That's a 96-unit deal. We're going to have you do a second a podcast with us. So for those of you who really enjoy this one, make sure you subscribe so you can listen to the next one. But the one we're going to talk today is a 75-unit property. Do you have a name for this property that we can use?
Yeah, we'll call it Warrior Apartments.
Warrior Apartments. So this one's going to be a 75-unit property. And first, before we dive into this, because I like to dive into the nuts and bolts, but I also want everybody to kind of know who you are at the same time before we start diving in. So give the listeners a little bit of a background about who you are and where your focus is.
Yeah, absolutely. So first off, thank you so much for inviting me to be on this. There's been some excellent guests already, and I'm honored to be in the same vicinity as them. So it's fantastic for me. I'm from originally Blacksburg, Virginia, and we're only known for Virginia Tech. So I moved away from there to Nashville area, Tennessee, to try to find something I wanted to do in life, and it ended up being real estate. The more I searched for the correct thing to do. I focused on the niche multifamily because I wanted passive cash flow and I like the economies of scale. And then the forced appreciation aspect, having that available was something that intrigued me. So I started studying real estate 4.5 years ago, and then I actually started investing. I had a long period of analysis paralysis, but I actually started investing about a year and a half ago now in multifamily deals. For very first deal was as a limited partner. So I joined someone else's syndication, excellent deal down in San Antonio. It's been doing well. I did a couple of those and to kind of learn the process and see what people are doing, understand their marketing, understand their processes and how they communicate with investors. And then from there, networking led me to my actual first deal that I was on the team. And that would be the 75-unit deal we're going to talk about.
So going back to what you did with this group in San Antonio, was this something that you did as just helping them from capital raising, or were you actually helping them find deals, or what was your role in that group?
I was just a limited partner. So
just
it was
passive investor.
Yep, just a passive investor. Very first experience diving into a deal, but they were good sponsors, so they were able to get me comfortable, and it was a good process.
Sure. So how did you find this 75-unit property?
Funny enough, it all goes back to networking, really. So I see you at a lot of events, and we're actually going to a lot of the same events here very soon. But I had built my network that way. There was someone who was trying to raise money for someone else's deal, and I caught wind of what they were doing. I believe her name was Monique. And I talked to Monique and was like, well, what are these guys looking for? What do they need? And she kind of explained what was going on in the deal. They had been investing in Birmingham for a while, Birmingham, Alabama. And I'm just up the street in Huntsville, Alabama. So I was like, okay, they're local enough. I'm just going to go drive down there, meet with these guys, see what they got going on. So it was just through exploring and networking with people that I was able to get lucky, honestly, and find these two guys who are doing it. And then from there, it's kind of history. We just clicked. They had been investing before 2008. So they shifted to multifamily in 2008 when they saw the market crash. Birmingham was a city that was hit pretty hard. Not that other cities weren't, but the steel industry, a lot of people just left the city, abandoned the city. Lots of jobs were lost, and then very, very high vacancy rates happened. So they had been flipping and doing the single family business at that point. And when they saw the opportunity to shift over into something that provides cash flow instead of relying on the market as much, that was important to them. So they made that shift, and I the reason I partnered up with them is because I knew they've had this experience, a lot more experience than me, and it's going to greatly reduce my chances of making a mistake. And that's important to me.
Sure. What was the purchase price on this one?
The purchase price on the contract was $750,000. So that's probably a little lower than most people are used to, but this was a C minus asset.
Was it C minus or was it really a D, but you called it a C minus to make yourself feel good?
Okay, so the property itself could probably be considered a D. The market, though,
Okay.
the market though, was better than a D class. I don't like to say D because it makes me think of Warzone. I guess that's what it is.
Yeah. Well, that's the reason why I say that is because my partner Brandon, he does that every once in a while. He might look at a property and he'll be like, it's kind of like a C minus. I'm like, no, that's like a C minus, 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 minus. It's almost a D. So we might as well just call it a D, you know?
I'm not super optimistic when it comes to things like that. So the 96 unit we're getting there, like it's a B. I'm like, C plus. I call it Birmingham B. But
that's funny. That's funny. So that one's $10,000 a door, right?
Yeah, $10,000 a door purchase price. But we had to bring some money to get it up to par, and we still have a ways to go to get it to the level we want it. But we are in the process of getting this one refied already. So,
how long have you had this one?
We closed September 6th. So we use a different model than a lot of the people you probably talk to. We didn't syndicate it. Not that for a purchase price that small, it necessarily needs syndicating anyway. But we'll go in and we might bring in one joint venture partner and we'll tackle the whole deal. And we like to buy them heavily discounted. Not that I think everybody likes to do that, but we specifically target 65% of what we think the value is going to be when we get our renovations done. So this one, we easily beat that target. The appraisal came in maybe, I think it was like 3 days before we closed. And it appraised as is at $1.925 million. So we got in for $750 and it was worth $1.29. And then we had spoken with the bank and, well, actually we used private money, but we had spoken with everyone and kind of let them know what our plan was. We planned to put $150,000 approximately in exterior renovations and some things to bring up the quality of the property, actual living quality for the tenants. And after putting in that 150, it was worth $2.3 million. So that's the approximate value we're sitting at today.
So you so the CapEx for the exterior was $150,000. What was your interior CapEx?
So we're going to use some of the money from the refi, which should close the first week of February. And we're not doing it exactly the same as a syndication. So we're literally it's going to be a process. We're going to go in and do the immediate things. So some of these units need windows, and we've got about $200,000 set aside for that. Not windows specifically, but for some of these items. So windows, there's several that need countertops. Most of them have relatively good condition kitchens, but some of them need some new appliances, things like that. We're going to go through and basically do what we'll call light turns. That'll put it closer to where market is as far as what people are expecting for a living space. And then over to add some more costly items. One of those being split level HVAC systems. So it has old heating systems. I'm not even sure what era they're from. And that's all it has. There's no air conditioning. So the tenants are having to use their own window units if they want air conditioning. And
so none of it's central air. It's all window units.
Yeah. Okay. So we've had contractors come through and we're building a plan for how we're going to do that, but they're all 1-bedroom units. So it's more of where we placed it that we're working on versus it being actually difficult.
And so for $200,000, you're going to do some window repairs, replacements if necessary, countertops, appliances, updating maybe some of the kitchen stuff, and then adding HVAC to all the units.
Yeah, and well, the HVAC is not included in the 200,000. That's included in the light turn. The HVAC, we're not sure how much that's going to cost us, but we're over the course of time just going to do it because we want to provide that value. Whether it really increases our returns or not, but it's just 4 guys and then on this deal.
Sure.
So we're able to make decisions in a slightly different way, and we know what our returns will end up being. And the cool thing about the deal, and this is why we like it, is we're going to have all our money out of the deal in the first week of February, which I think puts us at 5 months into the deal, if I'm counting correctly. And that means we can just reinvest that capital. So that's the big thing that we like, that, and then the fact that we bought it with equity. So it's going to cash flow over the long term, and we're going to slowly build it up. And then different from a syndication as well, we expect to hold it longer. So our refinance is going to have a 10-year term, and we expect to hold it at least close to that long. But we have the potential to hold it longer if we'd like, depending on how the cash flow and the market and things are going.
Mm-hmm. So what are you projecting the exit to be?
So we didn't actually project letting it go. I'll be honest, this was my first deal. So that's one thing I should have done. I actually have done that for the 96 unit deal. I kind of did it.
So let me ask you this: what's the cap rate on this in this market?
The cap around 8. So if you look at our appraisal, that's what they put the cap rate at.
What's bought the current NOI?
Today?
Yeah.
Shoot. Let me pull that up real quick because I don't know it off the top of my head.
What are these? what are these currently renting for?
Very low. So we've started turning some of them. As far as tenants, most of the tenants still had a lot left on their leases, but the average was below $300. The market is $525. We're not going to push. Say that again.
$525.
Yes, sir. Okay. So we're probably not going to even try to push it that hard because we haven't put in the HVACs yet. So once we've done that over time, we'll gradually put them all the way up to market value. But we can we've easily been able to get 400 on the last couple units simply because it's so much below actual market. But for us, it's increasing $120 per unit. So that's a big increase in cash flow. I've only been looking at in the last couple of weeks since we've been working so hard on this 96. I've just been looking at the cash flow, and it's around 8,000 total, and that's divided amongst us. But we're putting a lot of money into systems right now. So,
what's the expense ratio?
Expense ratio, it's a little over 50% for us right now.
Okay. So if I do the math on this right now, if I do $300 on average per door, it's going to be about $270,000 overall income, not including any other income or anything like that. And then you take out 50% expenses. Let's say $270,000, and then we're going to take out 50% for expenses. Messed up my calculator here. So 270,000. And then that's going to be $135,000 at an 8 cap. So you're right at about 1.687. Obviously, that doesn't include any income. That's the average. But if we do that same math and figure out, let's just say you get in 10 years, you get it to $500 per month per unit. You're looking at about $450,000 in income and 50% expenses, which is probably where you're going to end up being for the most part. You're going to be about 225 NOI. Dividing that by the cap rate, you're going to be right at about 1.8 million, 2.8 million, somewhere around in there. So 225 on the NOI on an 8 cap, you're at 2.8 million on that 10 year. So to be able to cash flow that thing and pay off. I mean, did you get any interest only on this new refi?
Yeah, 12 months. So that'll be cool as well. And when we underwrote it, a guy from LA were coming in and joining these two guys in Birmingham for this deal. And we underwrote it using like 25-year AMs and 7% interest rates because we didn't know what kind of financing to even expect. We knew we couldn't get agency debt on it. And so we just assumed it would be local financing or more smaller financing. But we were able to get much better terms than we expected with the 30-year AM and the 10-year term and the 12 months interest only.
So that was recourse debt.
The new loan or the old loan?
The new one.
The new loan should be non-recourse through I'm not sure if we ended up going with Lima Capital or one of the others, but Lima One. There's several.
Is it a small balance, like a Freddie or Fannie small balance, or is it a local bank?
It's not local, but it's not Fannie or Freddie either. But Anthony is the one that's more. He's better to ask on that one. I'm sorry.
No worries. This is a podcast where we ask the hard questions, Caleb.
Yep, I'll do it.
And I just ask the questions as they come up.
So we looked at lots of different options, but I'm not sure the one that we actually settled on. I just heard they just sent me the terms. So excited.
So all four of the partners would be signing off on that one as loan guarantor and all that kind of good stuff.
Not as guarantor, no. Just we'll be signing it as members. However, no one's guaranteeing it because it is non-recourse.
Well, yeah, even on non-recourse, there's usually you still have a loan guarantor for like bad boy carve-outs and various things like that. So, what kind of for this particular lender, do you know what the requirements are as far as like net worth, liquidity, or anything like that?
Basically, you just need the value of the property. Between the four of us, it's not even close, and we're relatively liquid, not super liquid at the moment with this 96 unit deal, but it wasn't that difficult to get this financing. No, the 96 unit, it'll be the same process. So,
well, what about property management for this one? What are you guys doing for property management?
So we have a in-house team. Anthony and Reggie, they've invested in nearly 800 units. The 96 will put them very close. I think it was like 787. So they have a lot of experience in Birmingham. And through that experience, back in 2015, they just started doing their own management. So we'll hire an on-site manager for the 96 unit. This particular one, we just have a part-time manager because they have another property a couple miles away, and it's relatively close, so it's very easy to manage both. I think that was an 80 unit.
So there's no on-site or anything like that. This is going to be one that's going to have just somebody locally that's going to be able to go show the units and various things like that.
Yep.
Okay. So on this particular one, how did you structure the deal with the various investors that are in it? 'Cause I obviously know that you're saying that you didn't really syndicate this one. You did more of a JV. There's 4 people in it. So how did you structure it with each other?
So it was about finding out what returns we felt comfortable with. So when we went in, we looked at the potential for the deal. We looked at what it was appraised for. We looked at what we were the refi to be, and then the cash flow. Me and my original friend who went looking for deals, Lawrence Pascua, he's in the Wheelbarrow Profits as well, by the way. Me and him just were like, all right, what's going to help us reach our goals? And how can we make this particular deal better than any deal we've seen? And so we just talked with Reggie and Anthony, like, hey, what can you give up? And they talked about the fact that they have all the experience. They found the deal. They have the management company and all these things. So what I did, it was like, I just want to be able to double this money quickly and then get it back. So I asked for 20% of the entire deal for my portion of equity. And then I was like, I'm going to trust your experience and your market knowledge and your connections, and give up a lot of the equity to you guys, because you're the ones that are really going to help me learn and get better. So 20% was what I asked for, and they were willing to do that. And then Lawrence, who put in a little bit less capital, he asked for 10%, and they did that as well. So what is that? 20, 10, 35, 35.
Okay. And did they bring any capital to the table as well, or was it just you and your other partner that was putting money in?
They brought some money, well, not to the table. So they paid for all the due diligence items. They had already sunk probably around $45,000 into the deal. Mm-hmm. And then they also put up their earnest money. So we came into the deal, and they drew a couple extensions, and it was quite interesting because they weren't frantic or pressuring away. They just wanted to see if we were a good fit, and they were ready to walk away from the deal if the right partner didn't come along, which I found interesting. But it ended up being a good fit, and we went from there. That is like the first question people ask me is, how much money are you putting into the deal? And I on the deal, I tried in what I can, but I always believe in the deal. It's just about where's my money right now.
Yeah, for sure. What was the occupancy level upon acquisition?
Upon acquisition, I believe it was 94%. It was a hair closer to that, or close to that, if not that exactly. I know it dropped pretty quickly after we acquired, down to about 88%, because we wanted to get rid of people that weren't paying and problem tenants. So if they had a large balance, or they had been causing problems, we gave them some time to kind of catch up. And then if they didn't, then we did what the law allows us to do.
Mm-hmm. What cap rate did you buy this one at?
It was just over a 12.
I was going to say, why do you think you were able to get this deal like this? Because it seems to me like if this owner is, understanding the market enough, that they would realize that the market was about an 8%. So obviously that's just going to be dependent upon some of the deferred maintenance and various things like that. But, to buy this at $10,000 a door, and then to be able to have the potential to remove all of your capital, on within 5 months. I mean, that's a phenomenal deal. So what was it that maybe the seller didn't see, or maybe was there something wrong with the seller and they're just trying to quick sale it, or what was the deal there?
I think it was the property itself, because at first I thought it was a mom and pop type owner, just based on how the property was running. But this owner was looking to get rid of a lot of units. So I actually went and looked at several of his other properties, and they were nothing like this property. They were B class assets, fee, they were charging pet fees and pet rent, and they were close to market rents, actually they were below market rents, but they were operating smoothly. They had professional management. They had amenities. So I'm thinking this was his eyesore property, or he didn't want to put in the effort to make this one better, because he already had some properties that were running smoothly, and there was no point in holding this one. But honestly, I don't know for sure. This guy owns 3,000 plus units, so he knows what he's doing. But
yeah, I've been just looking at this going, I wonder what he bought it for. He bought it for $750.
Well, he he's an elderly gentleman, so he's probably held it for a long time. I think the last time it traded was back in the 80s. I remember seeing that figure at one point, but
it was paid off for sure, probably.
It was paid off, and the negotiation process was easy too. So he didn't give us a hard fight. We offered. He's like, how about 750? And we're like, done. So that works.
Did you do any seller financing with this one?
Seller, no. We use private money. So my guys have been working with the same private lender for years now. Super good relationship with him. He was actually happy about this deal because it had a high occupancy. Some of the projects they had worked on previously, one was 0% occupied, and then one was like 50% occupied. But when it comes to economic vacancy or economic occupancy rather, it was maybe 30%. Gutters falling, and they put a ton of work into that one. And seeing that one is actually one reason I was super comfortable joining their team, because I knew they could handle this one. This one looked easy compared to the one that I got to witness, which is actually just a couple miles down the street. So
of this 750 plus, you have also another 150, so you had another 150. So you had 900 total into the deal, right?
Yes.
So you had 750 purchase, then 150 exterior, and obviously you're going to pay for the other stuff after you refi here in the next couple of weeks here into February, right?
Yes, and it's like maybe 922 or somewhere around there, because we rolled some prepaid interest in to our private money loan, but around that, probably like 925 at the most, and then we'll be refining at 1.3. So
what was your leverage on this one with the private money lender?
Our leverage as far as the percentage?
Yeah, like how much of the 922 did they give you as a loan for this one to get into it?
Oh, yeah. So they brought 750. They brought the full purchase price, and we just had to bring the renovation budget, which technically was just the down payment. He was providing the renovation budget, but with that being said, we brought 150 to the table. And then we had put some money into due diligence, like I said. So probably a total of, they had around 40 to 45 in it beforehand. Okay.
And so outside of, putting the money into this deal, what are some of your other responsibilities that you have on this deal?
So I am now in charge of what I do already, networking. And, what I'm trying to do is build a system for, as we get more deals, I want to be able to communicate with investors that we bring it onto our team, because the long-term vision is we will probably venture over to syndication. But for now, these deals are working so well, and we're not having to bring, it's not like we're raising $3 million. We're raising $400,000, and we're able to get it with one or two people, and then we just bring them in, and they get to experience actually operating the property. So it's been a cool experience. But I want to be able to help with communications, make things smoother, be able to bring in capital. And that's kind of what they expect me to do. And that's what I've been working on. So
what did you get as far as a rate on this private money loan?
Not great. 12% and 2 points.
Okay.
So the typical 12 and 2.
Yeah.
Or at least in the single family business. I had never even heard of people using private money in apartment deals until we did it. So
yeah, no,
I know
it's definitely an opportunity. I mean, obviously to have that short of a loan at 12% for 5 months with 2 points. I mean, I think that's a pretty solid deal, especially when you're able to, refi that person out within 5 months and, get into a permanent type situation with a 30-year AM and 10-year balloon. I mean, that's great.
Yeah. And, excuse me. The funny thing is, we started work on the refi, but then the 96 came along. So we we shifted a little bit. We're like, oh, we'll get it. Let's just work on this, and we'll come back and take the money out because the 96 opportunity was just too good to let pass. So we probably could be refied already, but we've been putting it on the back burner just until we get this one closed.
Mm-hmm. Plus with the holidays and stuff like that keeps coming up, all that kind of stuff slows people down too.
Yeah. Oh man, that frustrates me, but I get it. Not everybody has time freedom, so they gotta take advantage.
So what issues maybe came up during the due diligence process?
A lot of it you could just see.
Kind of already knew about it.
Yeah. So some of the things we had to do is trees from neighboring properties were basically on our roofs, and we came through and we trimmed everything, and we wanted to make sure the roofs were clean, and that it's tin roofs, so and they're relatively new, so they're in great condition. What we did is we just resealed those, but we thought we might have a potential issue there just because of how long these trees and things have been shedding who knows what on them. And then we knew that the HVAC could be a challenge, and so we explored that, but so far it's looking like that's going to be relatively easy. We're just figuring out between a couple different people, do we want to do it kind of like a wall unit and then just create vents, or do we want to do it in the way we did, or they did rather, in their last property with the split levels? So there were no serious surprises. It was all stuff we expected, and it actually went relatively smooth for a property that was this ugly. Mm-hmm. The thing that slowed us down the most was simply rain, because I guess it's the rainy season. I just moved to Alabama, so when you see the sun, it's a rarity apparently in the late time of the year and early part of the year. So
yeah. But even if something did come up during due diligence, you got a phenomenal deal on us. So there's not much retrading that would probably have to happen anyway.
Oh yeah. Well, yeah, we don't like to retrade. We had to a little bit on the 96 unit, and that's another story, but we'll get to that on the next one. But we want to go in with the best picture we have, having a great idea of what we're going to do. And then only if it's serious do we want to come in and retrade, because we don't want that reputation. We want to be able to have good relationships with these owners, because those guys have been in Birmingham their whole lives, so they know all these people. Mm-hmm. And then when they're looking to get rid of properties, we're not trying to take advantage of them. We just we want a good deal. So we try to just know up front.
Yeah. At what point did you, and I'm kind of stepping back a little bit, at what point did you guys actually tour this property, or had your other partners already toured it? You were kind of coming in after they already had it toured and everything.
Okay. So, well, they had toured it, and I toured it maybe 2 weeks before closing, and they had already toured every unit. And they do that every time. And we did it on the 96 as well. We'll do it with our contractors. And we look for trends. So if there's a common maintenance request that, especially with like leaking or things like that, we want to check that out. And if we see something that's concerning, then we'll bring in some sort of third-party inspector to check it out. But yeah, we go in, we look for trends. That happens very quickly after the contract. So as soon as possible, we're getting through the units. I just came along late for this particular deal. But usually I'll try it before we even have it under contract. And it wouldn't have worked on this property because there wasn't on-site management, but I'll try to get in the property as a potential tenant. And that gives me an idea of how the units are. I've done that on several properties here in Huntsville, and I don't always fit in perfectly, but I give it a try either way.
Well, one of the things that I do when I tour properties like that is I come up with this because I don't, when I'm coming onto a C-class property, I don't try to dress down. I just dress like normal. And so I usually come up with some sort of story as to like some sort of, I'm checking it out for a family member. And that way I can ask some different questions too about maybe like the unit mix and stuff like that too. So you can always come up with a story depending on how you look and stuff and how you're presenting yourself. So
Oh, I love the stories. That's my favorite part. It's like, oh, well, me and my wife are moving here. She's a engineer and is going to be working over there. And whatever it is.
yeah, the stories are great. Did you guys have to put up any hard money on this deal?
Are you talking about deposit?
Earnest money? Yeah.
No, and we try to avoid that. I know in a lot of markets that's a thing that is almost unavoidable, but we haven't had to do it, and we're gonna try to keep avoiding it for as long as possible. No.
What's the main strategy behind not putting up earnest money?
Or at least hard money. We just don't want to lose it. We
Do you find a lot of deals that you're putting offers on that you have not gone all the way through with them?
No. So I think I guess because we're going owner to owner so much, maybe we have that advantage. We've
You're not
offered
competing
on
with a bunch of other groups for this deal. It's just one-on-one.
Yeah, exactly. I think that's why we haven't had to, because we put offers in on a couple properties that were on the market, and we couldn't get the deal we wanted anyway, so there was no point in offering the deposit. So
Yeah. So you might not be going hard on these things, but are you putting up any earnest money? Like on this particular one, did you
yes.
put any money down?
Yeah, 25. We put 25 down.
Okay.
We did on the 96 as well.
Okay. So that's about 3% maybe? 3%, 3 or 4% of the actual value, or the purchase price. So that's not too unreasonable, especially when it's not, non-refundable. So
Yeah. Well, yeah, we had the opportunity to get it back. Obviously, it didn't come into play, but we just want to leave that door open if possible.
Sure. So what did you find easy so I always have like these last like two questions that I like to ask. And so what did you find easy during the entire process that you might have thought was going to be a little bit more challenging, but once you went through the whole process, you're like, wow, that wasn't that bad.
It's getting these actual projects done. The contractors are great. They've been doing a great job. It's not that difficult for us to expect. I guess they want to do great things, and they've done a great job. We haven't had to ride any pound as hard as I thought we would. I thought it was going to be more of a process getting it up to the level we want, or the level it is so far. But it hasn't. That's a hard question to answer for me.
Well, let's kind of go to the opposite of that. What did you find was a lot harder that you expected to be a lot easier?
This is easier to answer. It was patience. So while it was easy, there were always little things that come up, whether it be the rain, whether it be just finding out slightly more extensive repairs or whatever it is. It's just patience. It's going to get done, and let them do their job. Let them do a good job, and just wait. And I that's just inexperience for me, obviously. A lot of people, it takes them 18 to 24 months to reposition a property, doing it the way you would with agency debt. But we want to get out of this private loan fast. So I'm thinking like that. But just being patient was the hardest.
Well, I think you guys have done great with this project. I mean, to be able to buy it for $10,000 a door and then be able to refinance out and get all your capital out within 5 months, hold on to it for 10 more years, and have the potential to sell it for almost $40,000 a door. I mean, that's a phenomenal deal. You had a phenomenal find. And I'm already now looking forward to the next edition of the podcast that you're going to be on, which will be the 96 unit one. So we'll definitely have to get you back to discuss that one, because I'm sure it's going to be even better than this one, I would presume.
We'll call it safer for sure.
Safer. Okay. Well, better is relative, right?
I would say it's a better deal. Yes.
Yeah. Well, Caleb, how can people reach out to you if they have questions about this deal or other deals that you're working on, or you want to jump on a call with you to discuss a little bit further?
Well, they can call me directly or text me. I'm almost always hitting the phone. So my number is 615-752-8520. And then email's fine as well, relentlessinvest@gmail.com. And then I really love talking to people on Facebook and Instagram as well. Just search me on Facebook. Instagram is Relentless Investor. So look forward to seeing all of you there. That'd be great.
Yeah, and I know you're very active on the Multifamily Investor Nation Facebook group, and always introducing yourself and being, a resource there for a lot of people who are just joining. So you can always connect with Caleb there on the Multifamily Investor Nation Facebook group, which you can find by going to multifamilyinvestornation.com. There'll be a link there for you to sign up for our email list, as well as a link there to jump you over to the Facebook group. So.
Also, you do the live meetups as well. So I help host the one here in Huntsville. So if you're in the area, I'd love to see you come out second Tuesday at Panera Bread, Bridge Street. But check meetup.com if you really want to get there. And there's one in your area too, probably,
yep.
Wherever you're listening from. So.
Yeah. So if you want more information about the meetups, you can go to the same website, multifamilyinvestornation.com. And there'll be a link there to the main meetup page, and you can find the Birmingham one as well as the other 50 plus groups that we have across the country. So thanks for that plug there, Caleb. Thank you so much for taking your time with us today. For those of you who are listening, as well as you, Caleb, hope you guys have a good rest of your day.
Hey, Dan, appreciate it. Have a great one.
All right. You too.
All right, bye.